In 1980, total debt in the economy, that's all government debt and all private sector debt, household and business, totaled 125% of GDP. Today, that's 260% of GDP. So in ratio to the economy, it's more than double. So what happened to household wealth in that period? Well, it went from 350% of GDP to 600% of GDP. Households have gotten enormously wealthier because of the increase in debt. So if we went from our current 120% to 140% and so forth, a lot of what would happen would be that household wealth would continue to increase. Now, I want to amplify something that you also said, which is it's really the wealthy that benefit from this. Most household wealth, 70 to 80% of all household wealth is in the form of stocks and real estate. And what the increase in debt really does is push up the value of stocks and real estate. So as debt is increased, wealth is increased, but the gap between the middle class and the wealthiest has widened considerably, because 60% of the folks in the US, the bottom 60%, only hold 14% of the stocks and real estate in the country.
Yeah, that's terrible. I mean, they're just not getting the benefit of it. And well, we need to talk about inflation. Do you want to jump there for a moment? Because, I was going to say those people are hurt the most by inflation, whereas the wealthy that own the stocks, the real estate, and the mortgage debt against the real estate benefit from inflation. And, Richard, you don't know this, but I have a strategy I developed years ago called inflation-induced debt destruction, which is basically the fantastic benefit of having that long-term fixed rate debt where you pay it back in cheaper dollars over time as inflation happens. Now, for the record, philosophically, I hate inflation. But as a selfish investor, I'm going to try and benefit from it. So that's just an interesting thing to point out. But the folks that have only 14% share, that's bottom 60% that you talked about, that's more than half of the population, right? They're mostly not benefiting from these things. So it is very unfair and very unevenly distributed.
Well, you're exactly right. It's the middle class that gets hurt most by inflation. Your strategy for dealing with inflation is exactly right. If you borrow and your rate is fixed at a level below inflation, you're a net beneficiary. Now, a lot of people borrow and don't have fixed interest rates. So, as inflation increases, their interest rate goes higher, so they get none of the benefit you suggest. But yeah, inflation is...
So that would be like credit card debt, for example, would be a great example of that.
Variable rate mortgages, credit card debt, the like.
Yeah, even though, interestingly, the variable rate mortgage, you could still win because that mortgage rate will, even though it's adjustable, probably be lower than real inflation. And you're still leveraging. So you get the multiplier effect of the leverage, maybe, 5-to-1 leverage ratio. But that's complicated. We don't need to go into it. But definitely credit card debt, especially, because that is so outrageously overpriced compared to either, stated inflation officially by the CPI or real inflation, whichever one you want to argue. The credit card debt is just a complete scam, and it's so unfortunate. But yeah.
Yeah, if there's another way to borrow, you should.
Definitely.
If you can avoid borrowing altogether other than mortgage debt, that's not a bad thing either.
Yeah, not a bad thing at all. I could completely agree with you. But my point in asking you to address this is, does the debt cause inflation? Most people would say it does, of course. And if so, how much? That relationship between national debt and the rate of inflation.
If you ask 100 people whether increased government debt causes inflation, I think either 99 or 100 of them would say, yes, it does.
Yes, right.
But there's little or no evidence to support that idea. It's one of the amazing things out there. We have a very large database of countries. By our count, 47 of the 50 largest countries in the world, we have fairly complete government private sector debt information, money supply growth, inflation. We have all the data going back, at least to the 1970s, if not the 1950s. So we can go through and you could do this at home. This is you can go through and you look at every single instance of high government sector debt and see how many times it has been followed by inflation. By our count, there were 30 such instances, and it was followed by high inflation 7 times. And conversely, there have been, 30 something instances of high inflation that have been preceded by high government debt less than 10 times. We see essentially no correlation between the two. And we think that's, sorry.
When you calculate that correlation, though, and you say followed by, how much lag time are you allowing for that?
Well, we've run it a dozen different ways because you can define high inflation and high government debt and the lag time an infinite number of ways. So we've iterated that again and again and again with different levels. And no matter what you do, you can't contrive, a correlation. And, you couple that with the fact that government debt in Japan grew monstrously after Japan's 1998 crisis. I mean, that's when it grew to the 200 and something percent you're talking about.
Mm-hmm.
And inflation was zero for the next 20 years. Government debt skyrocketed after the great financial crisis in the United States. And our inflation was, 1.6% for the next 10 years. So it's really hard to find actual data support the idea that high government debt brings inflation.
So, Japan is a bit of a weird case. People could argue demographics, et cetera. And, the two economies around the world that always sort of befuddle economists, I think, are Japan and Argentina, right? Those two they're sort of like outliers in some ways. So let's not go down the Japan road, but let's talk about the US though. You said 99 or 100 people, or even probably economists, would say that debt causes inflation, right? And, that kind of makes sense when you follow that path. You can make the argument for that very well, and most do. Why do you say that's not true? Tell us about the argument for that. Just unpack that for us.
Well, we're empiricists. So, no matter what someone might come up with theoretically, we then go to the actual data, mm-hmm. which we have so much more mm-hmm. than folks like Milton Friedman did in the 1970s. We
Sure.
got 50, 60 years of the most important financial data that you would ever have. We just can't find it in the data. Mm-hmm. And we can't find it in the 1970s. We can't find it in the 1960s. We can't find it anywhere.